Hey guys, welcome back to the channel. Today I got a special one for you. This was sent to me by a viewer, and I don't know how this passed me by, but we're gonna dive into it. This might take a little while, might take a little time, but I think it's gonna be worth it to take a look at this. Um, if you're new here, please like, share, subscribe, do all that good stuff, and a pinned comment down below is all my affiliate links that you can use that no cost to you, helps you out, helps me out, and I'd appreciate it. You know, M1 Finance actually has brought back their $30 referral program. So if you haven't got an M1 Finance account, you can use my link down below. If you deposit $100, you get 30 bucks and I get 30 bucks. Win-win. So what are we talking about today? We are talking about DIVO. Now, some of you older guys like myself probably know DIVO, probably not spelled that way, but brings me back to my childhood, to be honest with you. But what is DIVO? Well, it's another income ETF that doesn't get a lot of radio play, or should I say YouTube play, but it's by AMPLIFY ETFs. And we're going to go through quite a few tabs here and just look at it, study it, and see how it works, if it's for you or not, my thoughts, and all that good stuff. So let's get started. So like I said, ticker symbol DIVO. It's the AMPLIFY CWP Enhanced Dividend Income ETF. It's an actively managed ETF. Mostly large cap companies with a history of dividend growth, along with a tactical covered call strategy on individual stocks. I like this. I like this already. You know, we always talk about QILD and NUSI, you know, some of the other ones. They sell covered calls on everything, right? Whether it's advantageous to or not. And I like this because it's tactical. That's just a cool word in itself, tactical. But DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. So what is DIVO? Well, it pays monthly, so that automatically makes it better, right? It has a distribution rate of about 5.5%, which is pretty decent. Net asset value as of April 8th, $34.84. So it's pretty affordable to buy on a per share basis. And let's just look at all the fund holdings. What you'll find interesting is that they only hold about 20 to 25 holdings. And we're going to see them all right here. United Health Group, number 1, Microsoft, Home Depot, McDonald's, Chevron, Johnson & Johnson, Visa, Honeywell, Apple, Goldman Sachs, Nike, 3M, JP Morgan, Walmart, Lockheed Martin, Duke Energy, Amgen, Procter & Gamble, Coca-Cola, Dow, Newmont, Verizon, ConocoPhillips, and Medtronic. Now, the cool thing about this is the tactical covered call strategy. Now, so they don't just take their entire portfolio and sell covered calls against it, or they don't just sell, you know, their entire portfolio value against an index like QILD does. They tactically sell covered calls. So at the moment, you know, they only have 4 covered calls out there. They have one on Chevron, and you can go look these up. Some of these are in the money. They might be buying these back. I don't know. We'll go over that and see. But they have one on Chevron, expires April 21st at 125. One on Nike, same date at 140. One on Apple, same date at 125. And one on Home Depot, same date at 295. These all may be in the money, but like I said, this is actively managed, so it's possible that they can buy these calls back. They might have profits in these stocks that they don't mind being called away. So this is similar to somebody that would manage their own portfolio, right? So for instance, if you ever watch my QYLD versus GW videos way back, I stuck with 20 stocks, but I sold covered calls on all of them because I was trying to maximize the income. This is very similar. They have 20 to 25 stocks, but they tactically look at each holding and say, okay, where can we sell some calls at, gain some income, and if it gets called away, no big deal. So those are the holdings. We look at it. What is their selection process? So they look for dividend growers for one. It's managed with a strong emphasis on owning high quality, large cap companies with historical dividend and earnings growth. DIVO is relatively balanced among the traditional 10 S&P sectors, with CWP determining which sectors to over or underweight based on various factors. Now, CWP is a sub-advisor of the fund. DIVO consists of 20 to 25 stocks, which are screened and adjusted according to attributes including market cap, management track record, earnings, cash flow, and return on equity. So you're only getting quality stocks here. You know, you're not just getting a basket of everything. You're getting, somebody that's screened all these stocks for their relative strength. And then tactical covered call writing. Covered call options are written on an individual stocks on a tactical basis, not an index approach. And here we'll look at the sector allocation as of March 31st. Pretty balanced. You got consumer discretionary at 15%, infotech at just under 15%, healthcare at 14%, industrials at 12%, consumer staples, where's consumer staples? 9%, financials at 8%, energy at 7%, materials at 5%, utilities at 3%, communication services at 2%, and 8% in cash. So the only thing they're missing is real estate. Now, if we look at performance, what's interesting about performance is we look at the fund since inception, annualized 13.94%. It trails the S&P 500 total return index by a little bit, but that's to be expected with the higher yield. What is interesting, though, is the CBOE S&P 500 buy right index, which I believe XYLD tracks, only has returned 5.76% over that time period. But you do get more current income out of the XYLD or the SBOE buy right index. And since DIVO doesn't follow an index, there's nothing to compare it to, but the closest thing would be something like, a covered call index. So what else do we have here? I think that's it on there. So the DIVO summary here, this just talks about how they have sub-advisors. The portfolio consists primarily of dividend-paying stocks that deliver cash flows from dividend and option income while offering the potential for capital appreciation. So it's pretty much everything I've gone over already. The one thing, though, concentration policy. The fund will not concentrate its investments or invest more than 25% of the value of its total investments in securities of issuers in any industry or group of industries. So they're not going to overweight heavy in one certain area. Yes, there's only 20 to 25 stocks, but they have it pretty well balanced. So what else we got? Specifically, they seek to provide gross income of approximately 2 to 3% from dividend income and 2 to 4% from option premium, plus the potential for capital appreciation. Unlike a systematic covered call program like QYLD, XYLD, those things, CWP is not obligated to continuously cover each individual equity position. When one of the underlying stocks demonstrates strength or an increase in implied volatility, CWP identifies that opportunity and sells call options tactically rather than keeping all positions covered and limiting potential upside. So that's the knock on the XYLDs and QYLDs, is that they limit the potential upside because they sell it at the end. Sorry, they sell it on the index at the money, right? So you're capping your upside. This one does not do that. They cap your upside on a few stocks that they decide is worth selling covered calls on. I hope that makes sense. Now, the next thing is taxation. So it's going to be the same thing like a QYLD. They are going to be mostly return of capital. You know, right here it says estimated return of capital is 71%, but that's just an estimate. These monthly ones are just estimates. If we want to look back to 2019 or 20, you can see that 82.7, I know that's hard to read, 82.77% was considered return of capital. And what does that do? Well, basically, return of capital, it's a non-taxable return of capital distribution. Where did it say it? Yeah, the portion of the distribution that constitutes a non-taxable return of capital will decrease a U.S. taxpayer's basis in the shares of the issuer. So I think all these covered call ETFs will mostly be return of capital. Now, with DIVO, though, what you could have, where am I here? What you could have is a potential for capital gain exposure. And right now, it's showing no capital gain exposure. But if we look back in Q4 of 2019, they did pay out a huge long-term capital gain. I wouldn't say huge, but a big capital gain of 85.9 cents. They didn't do that in 2020. Don't know if that's going to come up again, or don't even know if that's important to you. If you hold this in an IRA, none of that matters. The other thing about DIVO, one of the cons, I guess, turnover ratio, 86%. So, you know, the actively managed portion of this is they are turning their portfolio over quite a bit. Again, you know, within the fund that might hurt or help, because the fund's going to pay some transaction fees to turn over their portfolio. For you, that could generate capital gain exposure. Again, in an IRA, that doesn't matter. It might not matter to you at all. You know, taxes really are on an individual basis. There's nothing black and white whether something like that will affect you or not. So dividends, you know, almost 5% paid monthly. The other knock, 0.55% expense ratio. I think they had a waiver, because I've seen some where it said it was 0.49, but I think they raised it in March 1st to 0.55. So that's DIVO. I actually like it, because if you think about it, some people are going to say, hey, it's only got 25 holdings. It's not diversified enough. Well, you know, most investors, if I were running a portfolio, I probably wouldn't be buying more than 20 to 25 stocks, right? If I were running an individual stock portfolio. Because doing that, actually, it's a lot of work. It's quite a bit of work. Ask Dave over at Hidden Freedom Investing. He's got like 20, when he had 25 holdings and trying to figure out who to sell covered calls on, and et cetera, right? It's more work than people think. So this is just replicating that, right? Without the management part on you. So I like it. It can fit. Where does it fit? I don't know. If you're a heavy tech investor and you needed exposure to dividend paying companies, and you wanted monthly income that was relatively safe, I think DIVO could be a nice way to go, right? You get the upside potential, you get a decent amount of income on it as well. Now, if you look at where to go, look at the returns. I know we already did this, but I forgot. And here's a chart. The Amplify inception to date market price 10%. This doesn't include dividends, right? And then the CBOE buy right index is the lowest one here. So your 10,000 over the past 4 years, just in capital gain, capital gains, only grew to $10,770. Interestingly, the Dow Jones turned your 10,000 into 13.3, and the DIVO turned your 10,000 into 14.55. So not too bad, not too shabby. I like it. Like I said, I don't know if I would buy this. Maybe in my Roth, if I had some idle cash that I needed to, if I wasn't wheeling stocks in there, maybe something like this could work. I don't know, but I like it. Thank you to the guy that pointed it out to me. I appreciate it. He's big on that. I think he's got over 100K in this one, and I think he's done pretty well for it. So I hope that helped. If you have any questions, comments, leave them down below. If there's any other income funds you'd like me to look at, leave them down below. Leave me a thumbs up, like, share, subscribe, do all that good stuff. Check the pinned comment for affiliate links, M1 Finance. Check that out. Check us out tomorrow on Dave's channel, Hidden Freedom Investing, where we'll be talking options on the live stream at 6 p.m. Pacific Standard Time. Yeah, you guys have a great weekend. Talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.